Welcome back to Real Talk with Brian and Dan on 1150 AM KKNW. I'm Brian.
And I'm Dan.
Our next guest is David Jensen with Premier Mortgage Resources.
So David is a mortgage banker for over the last 27 years, and he specializes in HECM loans. What the heck are HECM loans? Well, they are reverse mortgages. David, welcome to the show.
Thank you very much.
Well, David did not want to brave the inclement weather out there, so he is joining us via the bat phone.
Thank you. You're very kind.
Real Talk Hotline. So, David, tell our listeners a little bit about yourself. What are you doing when you're not doing HECM loans?
My wife and I have a large family, and I enjoy my children and my grandchildren, and it's a good life.
Nice.
Great life.
Any hobbies besides the kiddos?
I love my grandchildren. They're special.
Yeah, that's good.
Excellent.
I know the feeling.
So we also like to ask our guests a little bit more about the home they grew up in. So tell us about where did you grow up and give us a fond memory of that house.
I remember growing up in Arcadia, California. I started grade school in a home that my father had built. I have myself and 6 siblings, so there were 7 of us, and my dad built a large home. And it was, homes are special. There were memories are formed. The teaching of the home is important and lasts forever. And those are critiques that I've had on my desires that I wanted to go ahead and share my business and with my children. So I think when we talk about families, to me, I think about homes. I think about the importance that it has on the posterity that we create.
So that home in Arcadia, was that a 4-bedroom, 4,000 square foot home or what?
It was a 5-bedroom, 2,500 square foot home.
Okay, that's a pretty good size for a family of what, 7?
7 kids and mom and dad.
Mom and dad. Wow, that's a lot of people in that home. Well, so let's get down to the nitty gritty. What is a HECM loan, or is it a reverse mortgage?
A HECM stands for Home Equity Conversion Mortgage. They call it for short HECM. A HECM is a reverse mortgage. The HECM reverse mortgage is actually an FHA loan set up by the FHA, guaranteed by the federal government. In the beginning, the HECM loans will allow homeowners 62 years and older to tap into a portion of their equity to help supplement retirement income. Borrowers don't have to make monthly payments. They must keep the home current on their taxes. They must live in the home. Homeowners can borrow either a lump sum up front or they can get income over the period of time, but the benefit is that they do not have to pay it back during their lifetime as long as they're living in the home.
So they're basically making no payments except for their property taxes and insurance.
And they must maintain the home.
Gotcha. Got to keep it up.
So I assume the maximum loan to value was determined at the time of the loan origination. What is the loan to value on a HECM loan?
The loan to value really is determined more by age than anything else. Oh. This is not a credit-driven loan, although you have to have a history of making your mortgage payments for at least 2 years. But it's supposed to be determined on that. And when you're age 62, that's the minimum age. They will lend about 38%. You get up higher, goes to 40, 45. I just completed a loan for this wonderful lady who lives in Issaquah, who's 98 years old, and they lent her 60% of the value of her home. So there's a range difference.
Right.
So there are a ton of myths out there about it, and maybe you can answer some of those. So, for example, can your spouse be thrown out of the house when one of you passes?
No, the government was very clear on that, and they've corrected that because sometimes spouses are under 62 years old. They've made the changes in the last few years so that spouses are protected, and they live in there as long as they stay in that home, as long as they live there, although you must start paying the loan when you turn 150 years old.
150?
150, yeah.
All right.
Sounds
I don't think they've started that process yet, but that's written in the document.
It's written there. That's funny.
So how about when, both the owners are deceased? What happens to the property?
This is one of the nicest things I like about it. I tell people that generally if you stock up your regular mortgage and you stop making the mortgage payment, well, the first month the lender's going to wink at it. Second month they're going to send you a letter, and the third month they're going to start foreclosure.
Right.
On this program, when the borrowers are no longer living in the home, they've moved out, they've moved into an assisted living home or something like that, they actually have 12 months. They have an automatic 6 months, and then there's 2 automatic 3-month extensions. So they give you 6 months to take care of it.
By take care of it, you mean sell the home or pay?
They
off the
have an
loan?
option of either selling it. They have an option of refinancing it and then owning the home, paying back what's owed on the loan.
Mm-hmm.
But that's when the money starts becoming due.
One of the maybe it's a myth, maybe it's a fact, but I've heard that the owner can get a discount by selling the home rather than letting it go back to the lender. A discount on the principal amount. Is there truth to that?
Really, in fact, let me tell you a quick story on that one. I have a gentleman who I knew did a reverse mortgage. I didn't know him, but I knew his kids. He did a reverse mortgage. He owned the home free and clear. This was here in the Seattle area. He bought the home for $500,000. He was able to get a line of credit. He didn't need any money, but got a line of credit for $300,000. And the way the line of credit work with the government is those lines of credit grow every year you don't use it by about 5%. About a few years ago, back in the 08, 09 era, he brought his family together and says, I've got some bad news. I've got cancer. I'm going to die in 2 months. He told his family what to do, and here's what they did. They celebrated that time. When it was done, he gave his family a check for $386,000, which was the accumulated value of his line of credit. So he had owed nothing against the home. He now could write a check. Immediately, he owed $386,000. The home during that period of time was only worth $300,000.
Wow.
Now, because they were heirs and the home was underwater, FHA allowed them to buy the home for actually 95% of the value at that time. So they went and paid, the value of the home was $300,000. They went and paid $285,000. Now they had $386,000 sitting in the bank, so they paid off the home. They owned the home free and clear, and had another 100 plus still sitting in the bank.
Wow, that's crazy.
Good story.
That's a great story. Thank you for sharing that. So these have got to be more expensive than a conventional loan, right?
No, they aren't. They're about the same rate as an FHA loan. You have an upfront mortgage insurance premium you pay on it, and the fees that are charged for loan origination fees are the same. We're limited and controlled by the government on that.
So then who is a good candidate? I mean, when you think about the people that you've helped, who's a good candidate for talking to you?
Well, for starts, they have to be over 62.
Okay.
Not both of them, but one of them must be over 62. I had a sweet woman who lived in Bellevue. Bellevue property's gone up quite a bit lately. She owned this home almost outright. She sold the home, and she obtained proceeds out of about $800,000. She needed to have income. She had was Social Security. Now she could have taken $800,000 and done that, but she wanted to have a home, so she went and used a HECM loan to do a purchase. You can do an FHA HECM purchase, and she paid about 50% down on it. So she put $400,000 down for a fourplex. She lived in one. She has income coming in, so she's now having income of about $6,000 plus a month coming off of her property. Before, all she had was about $1,500 a month Social Security.
Wow.
So, David, I'm a facilitator for Dave Ramsey, the Financial Peace University, and I don't know if you've heard Dave Ramsey, his take on reverse mortgages. So I'll throw
I've heard that, and
tough
I
question.
love Dave Ramsey.
Well, one of the things he says is a reverse mortgage is for people that do not want their children to have an inheritance. So can you address that? Can you talk about, and I think you did partially talking about the example with the that $386,000 withdrawal, but what would your response be to Dave Ramsey?
First of all, Dave Ramsey is a wonderful person. I'm a real fan of him, and most all the things he said. On this one, I will politely.
Yeah, we'll start the controversy here, right? Yeah.
So here's the point. A lot of people will say, "Gosh, I want to leave money for my kids. I want to do that." My answer is, "Hey, they're 40, 50 years old. They haven't learned how to take care of themselves. Now, here's the way it works
Dang
out.
it.
Buy them a financial peace course. Yeah.
Here's the deal. The lenders will not lend 100% on this.
Sure.
They're going to let the borrower is going to be able, the person who owns the home is going to be basically using approximately about half of it. The other half is still going to be there. Tell you what, time after time I go through, and part of the process requires us going through and taking it out for 10, 20, 30 years, showing them what is going to happen, using what the government pretends that they believe is going to happen. The federal government uses a term of 4% nationally for home appreciation. That's kind of the secret sauce that makes things work.
Yeah.
In the Seattle market, we haven't always had 4%, but we've averaged well over that 4%. Right. Everyone will tell you that. And if you take the numbers down and have a growth of the mortgage over time, you have a growth of the equity over time because of the appreciation of the home. The equity that's going to left for the estate will go on and on and on. Again, let me go back to my friends who, 98-year-old mother I used to do a loan for. They love what's happened. They said, my mother's living longer because she's living in her own home.
Well, and I wanted to point out something that, maybe you can speak to this as well, is, there are a fair amount of folks that are living in a home that are equity rich. They've got a ton of equity in it, but aren't able to maintain it or live a healthier lifestyle because they don't have the funds, right? They're living off Social Security, so that Social Security does not pay for maintenance on the exterior of the home. It doesn't pay for the windows being replaced. It doesn't pay for all of that stuff. And instead of enjoying their twilight where they can travel and go to Italy or they can go and visit their grandkids in Philadelphia, they're stuck in this home with equity and collecting Social Security. Correct me if I'm wrong, but that might be somebody you want to talk to about just maybe adding a little bit more income by having this reverse mortgage. Is that a good candidate for what you provide?
That's a perfect candidate. That's a great explanation you gave.
Because it does. I mean, I know I can think of people where I'm just like they're trapped. They've got their set income, and they took all their money and they put it in their house because they didn't want to have a big amount of debt. And they're just kind of sitting there going, well, we can go to the movies this weekend or we can do this, but they can't do anything else because they don't have any durable income. And they don't want to, like you said, they don't want to leave their children, with no, which I think is kind of funny at the same time. It's like Brian said, their children can take care of themselves, right? They need to learn how to, but it's kind of an interesting concept. And I think it's something that if there are any listeners out there that are thinking, I don't know, I'm scared. Brian's reference to Dave Ramsey, I think we get that, but there's got to be a responsible way to do this.
There is a responsible way to do that, and the federal government's done this. Generally, there's three aspects of an FHA HECM loan. There are one, generally they pay off the existing mortgage. Two, they generally get some cash up front. And then third, they get a line of credit. The line of credit cannot be touched for 12 months. The purpose on this, frankly, is they want to make sure that the homeowner doesn't suffer from too much immediate retail therapy.
Retail therapy. That's a good line.
So they go ahead and protect them. Their interest is protecting the senior citizens. They must take a class from a certified counselor that they have to have signed off before I can, frankly, start the process.
So, David, thank you so much for coming on and share this. We're about out of time. So, are you only licensed in Washington State, or can you do this anywhere?
I'm licensed in 8 different states and have connections with people in most of the states here that I do. Yes.
Okay.
David, how do our listeners...
I just recently closed one in Idaho for the people in Sun Valley.
Oh, okay.
She
stayed in her home, and now she has money for her green fees.
Nice.
David, how do our listeners get a hold of you?
I can be reached at my phone number at 425-260-5080, or they can contact me at my email, which is david.jensen@pmrloans.com. That's david.jensen@pmrloans.com.
David, thank you for coming on the show today.
Been my pleasure.
So remember that all segments of our show are available to watch on our YouTube channel. If you're interested in learning more about any of our guests, please subscribe. Join us after the break for some final thoughts and something fun to do.